Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to analyze interest rate fluctuations. Give us just a minute here to go live on all the different platforms. We got the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in. You can also drop any questions you have in the chat as we go through the presentation here today. Jose will be more than happy to answer any questions. And with that being said, it looks like we're live on all the different platforms, so we'll go ahead and get started. We'll take the chat off the screen for now, but keep dropping comments in there. Drop any questions you have. We'll go ahead and get into it. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender specializing in non-QM loans, and what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is go through a deep dive into a loan officer training topic. Tonight, we're going to be talking about something a little bit more general and top level, which is how to analyze interest rate fluctuation. So Jose, 28 years of being a loan officer, also being a finance major, right? He's the interest rate market analysis guy. So I will let him take it over from here and we will get into the presentation.
Good evening, everybody. Today is a great episode, right? We are all focused on the Fed. What's the Fed gonna do, right? Well, let me ask you a question. Do you even know what it means? Do you know any of the signs to look for? Do you know why the Fed does what they do? Well, in today's episode, I hope to enlighten our loan officers out there, as well as our investors, realtors, and anybody else that's interested in watching our podcast, to understand what all of this jargon means and how it could affect your profession, your business, your investments, right? There's different reports that come out, different, you see reactions that occur. So maybe it would be good that if you saw the information on those reports, you may have an idea of what's going to happen, what's going to be the reaction, and maybe realize, well, it's a good time to lock right now, right? This is basically what this is about, right? Is it a good time to lock today, tomorrow? Should we wait? So let's get right into our presentation where I can give you all some insights, hopefully empower you to make some good decisions. So I always like to break it down a little bit into the basics, right? What is interest, right? Real typical, because some cultures, some countries are interest aversive, right? They don't want to pay interest. They buy cash. Maybe it's because it's too expensive. Interest rates are really high. So what exactly is interest? Interest is the price that you pay to borrow money, and is typically expressed as an annual percentage. Now you're going to hear a couple of terms here like the prime rate, right? That's one of the factors. The prime rate is usually the index for HELOCs, for example, right? It's prime rate plus a margin. The prime rate is set by the Fed. Now, real critical words there, set by the Fed. The prime rate is an interest set by the Fed that commercial banks charge credit-worthy borrowers and is based on the Fed's overnight rate plus a margin. The Fed funds rate is the Fed's overnight rate that we're talking about, is the rate set by the Fed by which banks borrow and lend overnight to one another. And I break it down a little bit more what the Fed funds rate is in another slide. Treasury bills and notes are other interest rate factors there. They are the rate. The rate for Treasury bills and notes are set by the Fed. Again, set by the Fed, set by the Fed, set by the Fed. And funds the government. Treasury bills and notes fund the government. So what is the purpose of interest? Well, interest allows, and this is, I guess, a technical definition, right? Interest allows a coordination between savers and borrowers, right? Savers are paid interest for putting off their consumption until a future date, while borrowers must pay interest to consume more in the present. Obviously, it helps when this happens in a country like ours that has a lot of liquidity with money, right? That's the key, starting with the American dollar. Now, I want the last bullet point here to give a little context to interest rates and where we are today. The average interest rate over the past 52 years is 7.74%, with a high of 18.63%. That sounds terrible, right? 18.63% in October of 1981, and the low of 2.65% in the heydays of January 2021. So we're talking about Federal Reserve, right? So we all know the Federal, we hear the Federal Reserve, but do you all know that the Federal Reserve is not a government institution? The Federal Reserve is private. Federal Reserve consists of a federal agency and 12 privately chartered regional banks. That's like what you hear, the head of the Federal Reserve of Atlanta or the Federal Reserve of here. Those are the 12 privately chartered regional banks that consist of the Federal Reserve. The purpose of the Federal Reserve is to set interest rates. So you saw they set the prime rate, the Fed funds rate, all the treasury bills, treasury notes, right? The bills are the shorter term, the notes are the longer term instruments. Now, again, sets interest rates, manages the money supply. That's a critical one right there. Regulates financial markets and acts as a lender of last resort during periods of economic crisis. You all remember TARP, right? Troubled asset something program, the TARP program. Then we had during the pandemic a bunch of other stuff that occurred. Now, how does the Federal Reserve, how do they control rates? How do they manage money supply? How do they regulate financial markets? Well, one of the main ways is open market operations, which means the selling and purchasing of treasury bills and government securities in order to regulate the money supply in the economy, right? You all heard like monetary easing. I can't remember the Q2, whatever they were calling it, but they were monetizing, which means they were the U.S. Treasury was issuing the Treasury securities and Treasury notes, and then the Federal Reserve was turning around and buying them. That's not really the way it works, right? The Treasury is supposed to issue them, and then they're supposed to be, open market operations. But in this case, the Federal Reserve was buying them, right? So open market operations, like I mentioned, is selling and purchasing of treasury bills and government securities in order to regulate the money supply in the economy. The Fed funds rate, I mentioned that in the first slide, is the interest rate at which banks and other depository institutions borrow and lend excess reserves to each other, usually on an overnight basis to meet their capital reserve requirement. All banks have to hold a minimum percentage of their deposits, of their liabilities in a capital reserve requirement. Can't remember right now the exact amount. It used to be like 2%. Maybe that's still the amount. Some banks have an excess reserves and other banks are short. So what they do so that they don't fall into violation with the Fed and get shut down due to lack of liquidity, what they do is they borrow overnight. The banks that are short borrow overnight from the banks that have excess so that they can meet their capital reserve requirement, and the rate that they pay is the Fed funds rate. Now, right now, the Fed funds rate, which is the shortest term rate out there, is higher than, for example, the 30-year rate. We have an inverted yield curve right now. The yield curve is supposed to start from the bottom and then go diagonally up, right, to the right. But right now our yield curve looks like a U, right, where the shortest term rates are higher than the rates that get a little bit longer term. So right now the 2-year, for example, is higher than the 10-year, the 5 years higher than. That doesn't make sense because those are the instruments that they can control more to affect all of the other rates that follow, like consumer credit and mortgage, and you'll see in a minute how that all works. But the Fed funds rate has a lot to do with that, and if you all heard about inverted yield curve, that's what they mean. So, like I just mentioned, Fed funds rate is used to control monetary policy. It can influence short-term rate on consumer loans and credit cards, and then obviously affects the prime rate as well. And now we talk about the Fed. Now let's talk a little bit about the macroeconomic factors that also affect interest rates. Now, some of these are factors that the Fed is going to be involved, right? They're going to be messing with money supply, short-term rates, long-term rates. It's going to affect a lot of components. But when they're reviewing what they're going to do, right, what should we do? They're going to review, for example, inflation, right? That's like the big focus right now. Inflation is higher than it's been in the last couple of years, and the Fed has been very aggressively throwing a wrench into the machine to purposefully slow it down, to slow down the economic activity, to lower the rate of inflation. That's why you're seeing all the suffering that's going on right now with the high rates, is because they're trying to slow down the economy before it becomes hyperinflation, and then we end up with stagflation, a stagnant economy that still has inflation, which is the worst recipe that you can have. So the Federal Reserve counters inflation by raising the Fed funds rate, which increases all other borrower costs down the line. Unemployment rate is another macroeconomic factor that the Federal Reserve will review, because the logic is if you have a lower unemployment rate, you're going to have a hotter economy, because you're going to have more spending and higher prices, because there's more people working and making money. It's simply more people working, making money means more money is going to, there's going to be more purchases, and that affects supply, prices, all that kind of stuff. So believe it or not, one of the things that they try to do by raising rates and doing all these other maneuvers that they do is to increase the rate of unemployment. So you saw the other day, for example, last couple of days, the unemployment rate came in at 3.9% instead of the forecasted 3.8%. Oh, great news. It's slowing down a little bit, right? That's what they think. These are all the daily reactions you're going to see. These are daily fluctuations. Why your pricing changes sometimes on a daily basis. A report comes out, that 0.1% higher than they thought means something to these people that are just looking to grasp onto anything that they can to try to have an idea what's going to go on with this craziness with interest rates. So now they think, okay, things are going to slow down a little bit, so that's good. So the market eased up a little bit in the price, and we got a little bit better pricing the last couple of days in our rates, right? So higher unemployment rate means hopefully that they're not going to be as aggressively trying to reduce inflation. Conversely, lower unemployment rate means, oh man, or should I say lower rate is when I explained it, but higher rate, unemployment rate means less money in the economy, and then they're not going to be so aggressive. But the lower rate means more money in the economy, more spending, higher prices, and they will be more aggressive by raising rates to have a higher unemployment rate. And gross domestic product, that's a real good one, because gross domestic product, is basically the output of the country. manufacturing, production, services, all of that, import, export has, exports more mainly has to do with gross domestic product. So the higher the gross domestic product is, the better. Because if we have a higher gross domestic product, essentially that means we're going to be making more money and we're going to have less of a need as a country to borrow, which means we're going to be putting the Fed, the US Treasury, is going to be putting out less treasury notes and treasury bonds, basically less treasury securities out into circulation. Less supply of these securities means that they're going to cost more, which means that the yield will be lower, which means that the interest rate, because yield is the same as interest rate, will be lower, right? So it's an inverse relationship there. So higher GDP means country will need to borrow less, which means we'll have less issuance of treasury securities, which means we'll have a higher price on the securities that are being issued, which means you'll have a lower yield, right? Inverse relationship. So like I mentioned there, higher GDP will help keep inflation down as our need to borrow as a country will be less. So you see those reports come out talking about GDP is less than we thought, which recently GDP, I think, came out at like 1.8, which is pretty low. They were expecting a little bit higher. And that was like 2 weeks ago. So that was like the little dip we had 2 weeks ago. Then they got some other news, wasn't too good. So now we got some unemployment a little bit higher. So, this is like almost a daily battle. That's why we see so much volatility. But it's good that you understand the factors that are going to affect it, right? So we talk a little bit about treasury securities and their effect on mortgage rates. Because remember, we're talking interest rates in general, but then we're talking about mortgage rates, which is a subsector of interest rates. So I mentioned U.S. securities are debt obligations issued by the U.S. government and secured by the full faith and credit of the U.S. They're used by the government to help fund operations. They're used to affect the money supply through monetizing, which means issuing the security and then by the U.S. Treasury, like I mentioned, and then the Federal Reserve buying them back. And one thing to note when you are looking at what's going on with the Treasury securities, it's good to follow the 10-year Treasury because mortgage rates tend to follow the movement on the 10-year Treasury. Now, that's not the only thing that's going to affect mortgage rates. Obviously, as we all see in the non-QM world, it also has to do with the appetite for the secondary market for a particular type of product. So right now, DSCR is really hot. Bank statements are really hot, and I-10 loans are really hot, which means secondary has a good appetite for those. So you're going to have more guideline options, better rate options, better pricing on those than you would on the other non-QM types. That's why DSCR and investment is pretty much going hand in hand with conventional investment in terms of cost. And now with the new add-ons for second home and investment properties by Fannie and Freddie, DSCR or non-QM a lot of times is beating the conventional rates when it's investment property. And now, what are the effects finally here on interest rates? What are the effect of interest rates, right? The Fed funds rate, the discount rate, the prime rate, all these other components that I mentioned to you. What are their effect on the mortgage rates, right? This is where we tie it all in together, right? So the increase in the Fed funds rate by the Federal Reserve makes it more expensive for banks to borrow, right? Because banks, that's the rate that they pay each other for overnight lending. They pay a higher Fed funds rate. That cost, that additional expense trickles down to all the borrowers and all the customers of those banks. Higher fees, higher interest rates, higher everything. Because banks pass on the higher cost to consumers by raising rates on consumer loans and mortgage loans. Now, we were talking about treasury securities. Really important to note here, capital inflows and outflows of markets like the stock market also affect rates in the short term. How is that? Well, very very simple. Now, let's say you got one of these days when all of a sudden some great news comes out, such and such stocks, great, some good economic factors comes out that is going to be good for stocks. So everybody says, oh, today's a great day to buy stocks. So what do? They go to their money market where they got their funds parked, and they withdraw the money from the money market and use that money to buy stocks. That flow of money out of money markets and into stocks causes the money market fund manager to sell treasury securities. Why? Because where do you think the interest, um, income is derived on money market funds? The interest that they pay their account holders, because money market funds typically pay interest to the account holders. The interest income from those money market funds is derived from treasury securities, usually short term. The 1 month, 3 months, 6 months, a year. All of the short term treasury securities, the bills, are the ones that where the interest comes from. So then the money market manager has to sell his treasury securities to get funds to be able to give the money to the person that's cashing out their account to buy stocks. What happens there? Well, now you just sold those securities, you've added securities to the supply. So now they say, well, we got to be able to sell these securities that just came into the mix. What do? They got to lower the price on them, right? Supply and demand. You lower the price on that instrument, what happens? Inverse relationship again. The yield increases. They have to lower the rate on the security so that the investor that's buying these securities gets a higher yield, because the investor says, hey man, I need more. I need a higher yield because they're worth less right now. So higher yield equals higher interest. So that's why you're going to see on those days that the stock market's going crazy, market's up 300, 400, 500 points. On those days, there's a good probability that you may see the interest rates or the mortgage rates also inch up because of this movement. And then conversely, when treasury securities are bought, that happens when the stocks are sold, right? The person says, no, man, stock's going to go down today. Let me sell my stocks. They sell them, they get the money, and the money gets parked into a money market account. As soon as that money goes into the money market account, the money market fund manager buys treasury securities with that money to be able to make income for the account, and then pays the borrower their small proportionate share and keeps the rest as profit, right? So, I mean, this covers the main basic movements of money, and how when you hear all of those reports now from the Fed. I mean, there's a lot of different online sources you can go to on a daily basis to get your updates for the 10-year Treasury, get some financial news. I like to do it real early in the morning when I see the movement. Send that message out to the team. Today's a good day to requote your loans. Today's a good day to lock in those files, because you know that there's going to be downward movement in the rates, which means that the pricing is going to improve, right? So I hope that this does help those of you that are looking to empower your borrowers. We always talk about being loan consultants at the Mortgage Calculator. We're certainly not application takers. So when when your borrower asks you some questions, you want to be able to give them something that they can use. Obviously, the decision is always going to depend on them, but you have to provide, you have to empower them and provide the data and some guidance, so then they can do a little bit of thinking and then decide, yes, do I want to lock it in today, or do I want to lock it in tomorrow, or do I want to lock it in next week? Do I want to wait? But better safe than sorry. I would say that if you have a file that the customer agreed to a rate in the beginning, you may want to, lock that one in as soon as possible so that you're not stung with all this volatility, and then all of a sudden have a borrower be looking at you as the reason why the file wasn't locked. Now it costs a point and a half more for the same rate. And if I can't get that rate, I'm going to cancel the refi. And you've all heard that story. A lot of suffering and bleeding after that is going to go on. So keep all of this in mind, and really hoping that we can help you structure your loans and have you give some good guidance to your borrowers.
All right, perfect. I do not see any questions. Anything you want to add, Nick? I don't see any questions up here.
Oh. For some reason it keeps taking the graphic off. I would just probably add that Jose outlined the general items there. A lot of people like to look at the MBS, which is great. But remember, we do non-QM. So I think the best indicator to look at is the treasury, as Jose explained. And Jose explained it well, that's the general driver, right? A lot of people are looking at the specific MBS, bond for that specific MBS at that specific rate, and they're making their interest rate determinations off that. But remember, that's conventional. That's different than the overall. That's kind of a sub, and non-QM is not part of that ecosystem, right, Jose? Can you explain how that differs a little bit? Because a lot of people like to use MBS, which is great, but that's conventional FHA type, type
Right.
stuff, right?
The big difference there is agency loans, right? Deal with the agencies, right? Fannie Mae, Freddie Mac, Ginnie Mae. That's a pretty cookie cutter, and that's why that segment of the business is really going to track really closely with these macroeconomic factors because they're very liquid. Otherwise, there is no usual. I mean, you have some difference in overlays in some of these packages, but it's pretty homogeneous, and that's what gives it the liquidity. So there aren't factors to consider like what I was mentioning in non-QM, where they are secondary investors, multitudes of different investors buying these packages with a lot of different reasons why they want to buy that package, right? It's not just, well, the 10 years is going to track down tomorrow, but they're looking at the performance of the package type in terms of guaranteeing future income. So that's why certain segments of non-QM are now experiencing so much more growth, right? Because secondary has more of an appetite for them. That means they're going to be putting more of their money, not Fannie Mae, who has a full faith of the U.S. government, not Freddie Mac, not Ginnie Mae, but Wall Street companies that say, oh, sure, we like it. We're going to put more money into it now that adds liquidity. Or, oh, no, that's not a good segment. We're not going to put that much money into it. That takes away liquidity. Less liquidity means you have to entice the people somehow to buy it, right? Which means you got to offer higher rates, right? Sort of like what the Fed is doing with the treasury, securities, and all that kind of stuff when they're increasing them by selling them and increasing the supply. So the secondary market on non-QM, they're all private institutions.
Yeah, I was going to say private securities is different than, MBSs trade on the open stock market, right? You can basically trade MBSs, the agency stuff, on the open market, whereas you're talking about private market, right?
Right.
Private
Some
market securities, they're going to move in the general direction of the market, but not daily. They're not trading as frequently. I guess frequency is probably the biggest word to use there, correct?
Yep. Like some hedge fund, which, happened to come into, $10 billion, employs some company to say, okay, move my money, and then they come up with programs. Oh yeah, let's do a tranche of DSCR, and let's do another tranche of bank statement loans. Oh, ITIN's doing really good. Let's put some money there too. They're figuring where they're going to put the money, that there's good movement, that they're going to get good performance and liquidity. Right, that's what they're looking at, so that they don't get stuck holding an empty bag.
And it's different than the open market MBSs, agency stuff. Very different, same presentation, but different outcome at the end, right? Different frequency they're going to trade, different frequency they're going to change right?
Well, I mean, to put it, I guess, into perspective, if everyone remembers when the shutdown happened in the pandemic, right? Agency loans did not shut down. They just, tightened up the guidelines. FHA went up to like whatever 680 and this and that, but agency loans didn't shut down. But remember, bank statement loans, foreign national loans, DSCR loans, all those loans were like seriously, seriously restricted, and in some cases eliminated for a while because the investors said, "Hey, hold up a minute, we don't know what's going on here. We're not going to be putting our money into a black hole." So they held back and they waited till the dust settled, and then slowly but surely things started moving again in the non-QM because those were the money stopped. They closed the spigot, you know. So simply put, right now the spigot is running good in non-QM, and which you see when all of this action happened. Let's say the last 3 weeks, 4 weeks that we've had this rise recently, non-QM, especially DSCR, didn't go up that much at all. But agency, conventional, and FHA, they've gone up like almost 1%. But non-QM didn't because there's still an appetite for it. There's still liquidity. There's still movement, and they're still making money.
All right. Okay, I don't see any questions still, so we'll go ahead and wrap it up. Remember, we do this at 7 p.m. Eastern time every Tuesday, Wednesday, and Thursday now. This is new for us, but Tuesdays, Wednesdays, and Thursdays, 7 p.m. Eastern, where we do a new loan officer training topic. So we appreciate everybody tuning in. We'll see you next Tuesday, 7 p.m. Eastern, for the next episode of the loan officer training series with the mortgage calculator. Have a great night, everyone.